Hello, Marc. Hello, Eric. And thanks for joining for this very quick talk about your paper that we were going to publish now on prudence, the Prudence Principle of new framework for Eurozone fiscal policy. Could you say in a sentence what is behind the Prudence Principle?
Eric, you give one sentence and I'll give another.
I think the key thing, so the one sentence principle behind it is that we should have more focus on the actual cost of borrowing of the government. So the most important variable is the interest rate at which the government is paying on its debt. And if that rate of interest is lower than nominal GDP growth, governments have a huge amount of fiscal flexibility. And that needs to be embedded in our working principles for fiscal policy.
So therefore, being prudent is no longer hewing to a particular numerical rule, particularly in a post-COVID world. Hopefully, we'll finally get to a post-COVID world where everyone has 100% debt becomes kind of faintly ridiculous. Prudence in such a world, particularly when not just operational interest rates, the interest rate paid on debt becomes the most important thing. But when interest rates are in secular decline, as they have been in the West for a very long time.
How do you handle situations when interest rates go up and situation changes and maybe even interest rates go beyond nominal growth?
The practical reality of arithmetic. So let me give an example. If you take Italy, where the debt GDP ratio is, you think very simplistically of your arithmetic, if what is critical to the sustainability of your fiscal policy is the rate at which GDP is compounding compared to the rate of interest at which your debt is compounding. And that's really the crux of what Marc and I are observing, which is inherent in any sustainable fiscal arithmetic. So in other words, if you assume, let's take 200% of GDP because it's an easy number. If 200% of GDP is compounding at 2% per annum, that means that stock of debt is growing at 2% and nominal GDP is barely growing. You are very, very quickly going to be overwhelmed by your stock of debt. So the critical variable is this key point. Now, Italy happens to be nominal GDP growth, but if you take the last 10 years of nominal GDP growth, it is lower than the current rate of interest on 10-year or 20-year Italian government bonds. Now, that means Italy actually has to run a primary surplus. It has to run a surplus as a state before interest payments in order to stabilize the ratio of debt to GDP. But if we look at almost all other countries in the developed world, their GDP is compounding faster than their debt is compounding in a steady state. In other words, they can run deficits. That's one point. But there's a second important point that's really critical, which is why Marc and I emphasize the we put the interest rate on government debt at the heart of any fiscal discussion, which is even in Italy's case. Italy, for example, can make investments in solar and wind energy, which have 6% return on capital. Now, why on earth, if Italy can borrow in the bond market at 2%, should it not be making 6% return on investment? Because again, the simple financial arithmetic of that is that you're actually generating a positive return as a state. So that is wealth creating. So the crux of our argument has two components. One is, when we look at capital expenditure by the state, what we should be asking ourselves is the return on capital higher than the cost of capital? If it is, we should be encouraging states to do it because they create wealth. And the second dimension is when we think of the overall fiscal position, is if the nominal interest rate relative to nominal GDP growth is the key metric of determining your fiscal stance and the amount of space that you have in fiscal policy.
So let's address the current moment and inflation. So the argument would be, but if we have inflation, as we do have now, then the standard response is to raise interest rates. Therefore, that magic would disappear, and you would be back into a painful position whereby you would have to enforce austerity on economies. That, I think, is extremely questionable. Regardless of how long we say transitory is, the fact is that we're still dealing with a COVID pandemic. This is entirely supply driven. It is not driven by excess money, because what was dumped, for example, in the US in terms of income support was income replacement. It wasn't on top of an already overheating economy. So this stuff is coming from the supply side. If it's coming from the supply side, can it have embedded effects, alter expectations? Yes, absolutely, if it continues long enough. But let's remember, again, where I'm sitting in the US, corporate profits have never been higher. And at the same time, for the first time in a very long time, wages for the bottom 25 to 30% of workers are actually increasing. We should be celebrating this because there's still plenty of spare room in the economy to make that happen. And if we do that, we're going on a way to creating a high growth economy, which embeds exactly the trend that Eric is talking about. So rather than leaving it to the vagaries of the market to determine R and G and its relationship, we can positively impact the G in such a way that this can work for us and be made to work for us.
Would you make a difference between the US and Europe, nevertheless, when it comes to?
Well, you're still hit by the same supply chain shocks and constraints. So ultimately, you know, I don't think I might have missed it, but I don't think that the Eurozone went on a huge fiscal splurge in 2020 and I missed it. What we saw was effectively income replacement. If we're talking about the European fund that was built in 2020, it is still to be disbursed. So that can't actually be causing any inflation. So I think what we have is a sort of a very opportunistic moment when people who are traditionally very averse to inflation because of the effect that it has on their personal and professional reputations and assets, shall we say, are getting the ketchup bottle out and making the usual arguments. But we don't live in that world. There is no wage price spiral. There can't be if corporate profits are very high and stock markets are booming.
Eric, how do you explain that nevertheless financial markets seem to be a little more nervous than probably you are?
Well, let me make a couple of points on this, Thomas, because first of all, I want to go back to a really fundamental point, which actually Marc and I wrote an article in Foreign Affairs. Was it
2014?
2014. We wrote an article in Foreign Affairs saying print less and transfer more. And really what we were arguing at the time was against quantitative easing. So our observation was that printing money, i.e. printing money and buying assets in financial markets, which is what quantitative easing is. And that's what we said, do less of that. So we said print less money and transfer more. In other words, transfer money to the household sector, literally checks in the post. And our argument was a very simple one, which we made at the time, which is if you transfer money to households, you will stabilize income. And that should be the objective of counter-cyclical monetary and fiscal policy. And a lot of people at the time said, don't be ridiculous. People won't spend it. There was a lot of rejection against it. I think what the controlled experiment under COVID has absolutely vindicated that article, which is if you want to stabilize your economy and prevent recessions, you should print less and transfer more, right? So what we can observe, I think, conclusively now is that there is a huge difference between printing money and buying financial assets and printing money and transferring it to households, right? So in a way, what we've actually done, we should really now have solved the recession problem because we know what to do. When the unemployment rate starts to rise, you put a check in the post, you stabilize household incomes, you can stabilize nominal demand. That's what happened. Okay, so I think, but that's a really, really important point that one needs to accept. There's two separate issues that have arisen subsequently. One is we have very, very volatile levels of inflation currently. Hugely depends what geography you're in. Japan is still in deflation. If you do a cross-section of the world, there's a very, very wide dispersed picture. And then we have another question, which you've just raised, Thomas, which is what is going on in financial markets. Now, the interesting thing is I would say financial markets are more sanguine than I am. I'm actually astonished. I just checked on my screen what the yield on 30-year treasuries is. Now, if you had told any of us that that the global economy, but particularly the US economy, because this is 30-year treasuries, would recover with the most rapid V-shaped recovery we've seen in any recession, right? I mean, if you look at it, it's phenomenal. You're back to a rate of GDP growth that is above where we were pre-pandemic. So we've had a phenomenal V-shaped recovery. We have these huge volatility in headline inflation, lots of talking heads like us worrying and debating the inflation picture. Would we expect 30-year treasuries to be 1.85%? That's absolutely astonishing. So the reality is everything that Marc and I have argued in the article about fiscal policy still holds. And that isn't what interest rates are going to do in the next 6 to 9 months. That is a 30-year treasury. Right? So that is a fixed rate of interest for 30 years. The US government can borrow below 2%. So financial markets are saying the world has not changed because the yield on long-dated government bonds has not changed.
Now, what would be disruptive to this is continuing to boost asset prices. So a little bit of news out of Britain the other day. Untaxed gains by households at the top end of the income distribution due to the acceleration of property prices is £3 trillion. So that's a huge upward redistribution that's happened and is consequential. Yet we talk vaguely about housing inflation, but we don't really want to do anything about that type of housing inflation because of the political constituency surrounding it. If we were to raise interest rates in relation to the inflation we're feeling at the moment, if it is a supply side issue, as I believe that it is, then that's not going to do anything other than slow down the economy and create unemployment. It's also going to create the conditions in which arguments to taper, which I think we should do, because as Eric has just outlined, simply transferring more and printing less is the right thing to do, will actually go into abeyance. You will continue to do this. So to us, I think, and I'll speak for Eric in this one, you can correct me if I'm wrong, essentially central banks need to get out of these asset supporting game and get into the income supporting game. And if they're uncomfortable doing that, then we should just revert to a world in which we have fiscal policy and explicitly do this. In which case, all you need to worry about is operational level of interest rates on your long-term debt, which, as Eric said, is ridiculously low and hasn't shifted even in response to a giant pandemic.
Do you think that one of the central banks will follow your idea, more transfers? Is that something we still need to convince central bankers?
Well, I don't think. Sorry, Marc, go on.
Get central bankers out of the game. That's not their game. This should be and is a fiscal policy. So I think one of the things that we've seen in the pandemic is not fiscal dominance re-emerging, which isn't nearly as scary, I think, as people think. But nonetheless, it is a sort of a reassertion of the fiscal. Because all you can do with monetary policy is essentially catch falling knives and support asset prices. And that has become both kind of dysfunctional and an inequality generator. We need to have less of that and more explicit fiscal policy. And with that, the attendant democratic politics that would discuss what is that fiscal policy, what should it look like?
Okay. Eric?
Yeah, Thomas, I might add that also in Angrynomics, one of the ideas that Marc and I advocated was the ideal of dual interest rates, which is that central banks could get around the problem of the lower bound. So this is the problem of, once the ECB gets to minus 50, minus 75 basis points in interest rates, it starts to cause more problems than it solves. So how do you get around that problem? And one of the things that we suggested is that the ECB should use dual interest rates. And what that really means to the layperson is that you raise the interest rate on deposits and you cut the interest rate on loans. And in fact, theoretically, and as a matter of practice, that solves the problem of the lower bound. There is no lower bound if you shift to dual interest rates. Now, the precise mechanism that Marc and I recommended the ECB use is that they could use the targeted lending program, the TLTROs, and further cut the interest rate on TLTROs while stabilizing or raising the interest rate on reserves, which they pay to banks. And we do actually go further in Angrynomics and suggest that the targeted lending program should be oriented towards sustainable energy investments. Now, I really do want to revive this debate because I think this is a far more productive and politically acceptable form of monetary policy than financial asset purchases. And the reason I want to revive this debate is that I don't believe that we will never see a recession again. If you look, on average, you've had at least one recession a decade in the post-war era. So just because we currently looks like we've got a kind of post-COVID boom, that's absolutely fine. So I'm not recommending this be done right now, although I think the TLTRO could be repurposed. That would be a very, very helpful thing to do. But I absolutely think we need to design this policy so that if we do hit a bump in the road economically in the next 3, 4, 5 years, we immediately instigate dual interest rates in Europe oriented towards sustainable investment spending in the green economy. Because we need to be a lot smarter about monetary policy. We've learned a lot of lessons over the last 20 years. Monetary policy has completely changed. It looks nothing like it did. The problems we're facing are completely different to what we faced 20 years ago. And frankly, asset purchases and negative interest rates alone have huge, huge sets of problems. And what the central bank should be doing is adopt dual interest rates targeted at sustainable energy investment.
Very interesting, very good. Marc, last remark on maybe something on you would recommend to Europe.
Sure. I mean, let's think about it this way. How is Europe is serious? Europe is the one part of the world that's very serious about a green transition. And you can see the structural funds morphing into transition funds, and you can see the new German government making more than noises, actually really committing. France is moving in that direction. There's lots of stuff in hydrogen. There's lots of stuff in interesting tech spaces. It's all good. But how are we doing this? We're still doing it with the language of let's go back and talk about the fiscal rules. We're still doing this with off-balance sheet vehicles. We have to do this through some kind of subterfuge. You're never going to get there if you're not honest. Let's use this as an opportunity for honesty and transparency and say, you know what, we can do this, and we don't have to do it by pretending we're not taking on debt. We can do it by actually talking about how we're building assets. We can do it through the power of the central bank, not to catch fallen knives and give more income and assets to those that already have the most, but to effect a transformation that is a just transformation because it builds assets for everyone. And I think that this is an opportunity that we have rather than a risk, and I hope that Europe embraces it.
Thanks. Let's hope for us all. Thanks, Marc, Blyth, and Eric Lonergan, and thanks for your paper that will be published now at our website, The Prudence Principle, a new framework for Eurozone fiscal policy, and happy to speak again soon and have you back at any point next year. So thanks.